Hi everyone, my name is Mishkin Santa and I'm the International Tax Director here at the Wolf Group. Today we're going to be talking about the age-old question, who is a U.S. tax resident? Well, a U.S. tax resident falls into one of three categories. The first category are United States citizens, okay? So if you're a United States citizen, you're going to be a U.S. tax resident. Doesn't matter where you live, reside, or make money. You're going to be taxable on your worldwide income, and you're going to have to produce international informational reports on your worldwide assets if they exceed certain thresholds. So that's the first bucket, U.S. citizens. The second bucket are U.S. green card holders. If you have the U.S. green card, 99.9% of the time, you're going to be subject to worldwide taxation and again, worldwide informational reporting subject to certain thresholds. The third bucket is what we call the substantial presence test. The substantial presence test basically is for people that are not green card holders and not U.S. citizens. They're for non-resident aliens that are present inside of the United States. In most countries, the test is 183 days in the calendar year. But in the U.S., we like to do things a little differently. The test is still 183 days, but it's a three-part test. We count 100% of the days in the current year, 1/3 of the days in the previous year, and 1/6 of the days in the 2 years previous. When you add them all up under that convoluted formula, if you exceed 183 days, then you satisfy the substantial presence test, you're a U.S. tax resident, and congratulations, you're subject to worldwide income taxation and international informational reporting. So again, to summarize, who are U.S. tax residents? Three buckets: U.S. citizens, green card holders, and individuals satisfying the substantial presence test. Hi everyone, my name is Mishkin Santa and I'm the International Tax Director here at the Wolf Group. Today we're going to talk about G4 visa holders. Are you a resident or a non-resident? And as a G4 visa holder, you're probably a full-time employee of an international organization, and you may have heard your colleagues say, we're G4 visa holders, therefore we're non-residents and we're not taxable in the United States. That's actually factually incorrect. G4 visa holders are taxable on many sources of income, such as U.S. dividends and rental income. But let's talk about residency versus non-residency. G4 visa holders are non-residents, but when you look at the Internal Revenue Code, there's nothing in the code that specifically says G4 visa. But here's what it does say. If you're not a U.S. citizen, you're not a green card holder, you are a foreign national coming to work at an international organization full-time as an employee, then your days within the United States do not count as physically present. If the days do not count for being physically present, then you can't ever trigger the substantial presence test. If you can't trigger the substantial presence test, then you're a non-resident alien for U.S. tax purposes. So it's not the G4 visa that does the trick, but rather the fact that you have a G4 visa and you work full-time for an international organization as an employee. Hi everyone, my name is Mishkin Santa and I'm the International Tax Director at the Wolf Group. In today's segment, we'll be talking about G4 visa holders. When do I have a tax return filing requirement? This is a fantastic question, and I can say that typically there are three scenarios in which you'll have a filing requirement, where you could have a filing requirement, okay? The first scenario deals with what we call effectively connected income. In the tax world, we call this ECI. The second scenario deals with what we call fixed, determinable, annual, and periodic income, and in the tax world, we call this FDAP. The third scenario deals with what we call a foreign disregarded entity, and in the tax world we call this DRE. Let's walk through all three of these scenarios to figure out if you have a U.S. tax return filing requirement. Under the first scenario, when we talk about ECI income, the most common example is wages. And I know you're saying to yourself, wait a minute, I'm a G4 visa holder, I work for an international organization, and I get paid wages. Is that ECI? The answer is no. Because you're a G4 visa holder and you work full-time for an international organization, those wages are tax exempt. So you would not have a filing requirement if that's your only source of income. Let's change the facts slightly. Let's say that you're a G4 visa holder, you're working full-time for an international organization, but now you have rental property and you have a tenant that's paying you rental income. Well, guess what? That rental income, that's ECI, and you now have a tax return filing requirement. Let's change the facts again. Let's assume that you're a G4, you're a full-time employee for an international organization, but your spouse is not. Let's assume your spouse is working as an employee for not an international organization, so a non-international organization. Her wages would be ECI, and therefore she would have to have a tax return filing requirement. Now let's move on to FDAP income. FDAP income is typically income like U.S. dividends, capital gains, and certain types of interest income that are taxable to non-residents. Typically speaking, the G4 must submit Form W-8-BEN to their provider in order to make sure they have the right withholding tax rate. If they fail to do this, or perhaps have the wrong withholding tax rate, then they may have a tax return filing requirement. That's why it's critically important that you properly complete Form W-8-BEN. Under the last scenario, we'll discuss the DRE, or disregarded entity filing. This typically occurs when a G4 creates a business entity, sometimes known as an LLC. Maybe they do this for their own private business, or perhaps they use it for rental property. But regardless of why the business entity is created, as long as the business entity does not file what we call a partnership or corporation tax return, it will be treated as a disregarded entity filing. This filing is pretty critical because it contains IRS Form 5472, and failure to either file this form or properly complete this form is a $25,000 penalty. So make sure you do that one timely and properly. Also, you should note that this filing requirement began for tax year 2017. So if you have any issues related to tax years 2017 or moving forward, you should seek out the advice of a qualified tax practitioner. Hi everyone, my name is Mishkin Santa, and I'm the International Tax Director here at the Wolf Group. Today we're going to talk about the Foreign Earned Income Exclusion. The Foreign Earned Income Exclusion is fantastic because it allows the individual to exclude from their taxable income amounts in excess of $100,000, and that amount changes every year, so I'm not going to give you a specific amount, but it changes for each tax year. In order to qualify for the Foreign Earned Income Exclusion, you have to have two things. You have to have foreign earned income, which we'll talk about here in a minute, and you have to reside abroad. So your residence or your home has to be in a foreign jurisdiction. Okay, so let's talk about foreign earned income. Foreign earned income is typically wages or consulting income. What it's not, though, is it's not passive income. So if we think about passive income being interest, dividends, capital gains, that's not what we call earned income. So you can't exclude passive income under the Foreign Earned Income Exclusion. Okay. As far as your tax residence or your country of residence, you have to live and reside in a foreign country. So if you have foreign source earned income and you live and reside in a foreign country, you may be able to access the Foreign Earned Income Exclusion. And there are two tests, and you only have to satisfy one of them. The first test is the bona fide residence test, which is a subjective test. And the second test is the physical presence test, which is an objective test. Okay? The bona fide residence test basically says that if you live and reside for a full year in a foreign jurisdiction, you may be a bona fide resident and be able to take the bona fide residence test for the Foreign Earned Income Exclusion. Now again, this is a subjective test, so we have to look at a couple different factors. Where does your family live? Where is your car registered? Where do you have your driver's license? Are you paying taxes in the foreign jurisdiction? Do you have a certificate of tax residency? These are all subjective parts of the test, and you look at them all together to make a determination if you qualify for the bona fide residence test. The second test, which is a lot more straightforward, is the physical presence test. And basically what the physical presence test says is, did I live outside of the United States for 330 days or more during a 12-month period? If I did, then I may be able to qualify for the physical presence test and then take the Foreign Earned Income Exclusion. If I qualify under one of these two tests, I need to file IRS Form 2555. I need to report the information that makes sure that I qualify under one of these two tests, and I need to file it with my Form 1040 tax return. So again, you have to have foreign source earned income, you have to live and reside in a foreign jurisdiction, and you have to qualify either as a bona fide resident or under the physical presence test to access the foreign earned income exclusion.